let me come down to the most important part, money management. Now, what is money management? It is the combination of technique which involves the amount of money to be risked per trade, the amount of leverage to be taken, the number of lot size, contracts and shares that can be taken, the number of times you can trade without being ruined. Like in any let me draw this with a military analogy. Whenever a commando operation or a training of a commandos take place, the first thing that they are taught is not how to fight. The first thing they are taught is how to survive. Because if you are able to survive, only then will you be able to fight. So the training given to them is the survival techniques, and then they are taught how to fight and kill. The same thing is there in money management. Perhaps let me tell you a very interesting fact, that in America it has been seen that most of the ex-Marines are very good traders, because they know that when to exit and how to survive, and then go for a killing. Now, money is limited with everybody. This is something which we need to absorb. Even for that matter, for some big player, 1,000 crores will be a limited amount of money, because he takes such a big position. For players like us, 1 lakh, 2 lakh, 3 lakhs is, I mean, it again, I would like to say, it is based on everybody's appetite. How much money are you ready to risk per trade? Always have a figure about that. What do I mean to say? Let me put it. Make a particular, before entering a trade, make a particular vow to yourself. Come what may, my stop loss will not be more than 10,000 in this particular trade. If you are trading a cash stock, okay, based on that particular theoretical amount which you have taken into consideration, fix your stop loss and take the amount of lots you want to take. So if your stop loss, for that matter, in any simple future asset class of in future equities or Nifty, you can do 2 lots on a breakout with a stop loss of 10,000. But in case of gold, big gold, you cannot even, I mean, the stop loss will become a very tight stop loss. So you will have to go to gold mini to take that particular amount of trade for a stop loss of 10,000. So define a stop loss, a monetary stop loss, not your technical stop loss. Technical stop loss you will have to define, but always define your monetary stop loss. What is the amount of leverage which you will be taking? Now let me tell you, in the book Market Wizards, it is generally, after reading all the, I mean, most of the traders, it is generally noticed that it is 1:3 is the ratio which you should be taking into the market. That is, if you have 100 rupees, the maximum amount of leverage you can take is 300 rupees. Now you will say that I have gone mad, because in case of MCX gold, 23 to 24 lakhs is the value of the contract, and the margin is 1.5 lakh rupees. Okay, so ideally, going by my theory, you should be having something like 7 to 8 lakh rupees in your account, and then you should be taking 1 lot of gold. Well, this is what is the nomenclature across the globe, and that is the reason why the mortality rate of clients in Indian commodities market is so high. I mean, I'm sorry to say, but a client, an individual client, does not look into this particular aspect at all. And this is the most important amount of aspect. If you don't have that much money to commit to a single lot of gold, it is better to go into gold mini. It is better to save money and trade for little profits than losing the entire money at one stroke. Taking a simple account that if I mean, the volatility of gold when it was in an uptrend, or even when it was downtrend, was something like 150 to 200 rupees per day. So going by a logical explanation, the person can be wiped out in a matter of 2 to 3 days. Your entire trading capital will get wiped out. So even if the exchange says that no, only give me so much margin, you should have, because exchange is not bothered about your wins and loss. Exchange is getting its brokerage. You are the one who is responsible for the wins and loss of your trade. So even if the exchange is saying that we take only this much amount of margin, don't fall into that trap. I have seen this happening with many CFDs in based in UK and elsewhere in Europe, wherein they say that we take only 2% of the total margin and you can start trading. But do you know that 99.9% of the clients who enter into these types of trade get ruined out? Even they lose that 1% or 2% of their capital. So avoid falling into that trap. First of all, how you should do it? I mean, if anybody is doing cash market equities or taking equities, of course you have to play your entire cash. That is the reason why many people don't lose money, or they are at a very very comfortable level mentally when even if their stock is going down in the cash markets. That no, everybody becomes long-term investor because they know they have given 100% of the money. So first, when you enter a particular futures market position, know the value of that contract, and then on basis of that decide that ideally it should be 1:3, and then you should decide that this I can take this particular contract or not. Of course, your numbers have lot size and shares can be decided on the same thing. Now, how many number of times you can trade without being ruined? What do I mean by getting ruined? Just a minute. Just a minute before I go further into it. I have certain questions which I would just like to say. What is the admin has said that what is the value of ATR? Now ATR has different, each and every asset class has a different ATR. Our ATR of Reliance will be very different from the ATR of HDFC Bank. ATR of Nifty will be very different from ATR of gold. So each and every ATR value of an asset class, it depends on what is the value of that asset class, and then the ATR is decided accordingly. What I want to say is use a 14 period ATR, 14 period ATR is generally what is used in the market. So you have an ATR. Most of the charting softwares have ATR function in it. Use the 14 period ATR by and it is by default to get that particular value. One more reason I want to tell you about the risk of being ruined. Now, what do I mean by ruined? By ruin, I mean, suppose your total trading capital is 4 lakh rupees. You take 4 lakh rupees, you sit in the house and you say, I want to be a trader. I will now trade for a living. I assume that when you lose that full 4 lakh rupees, at that point of time, your trading account is ruined. Okay. And how many number of times you can take a hit and come back into the market? So I said to you that you have a value wise stop loss of say 10,000 or 20,000 rupees. If you divide 4 lakh by 20,000, still it will be 20 times you will get hit on the market and you can come back in the markets. Okay. What is the worst thing you can do to yourself is when you take that 4 lakh rupees and put it on a single trade and say that this is a matter of life and death for me and the account. The day you do it, believe me, even if you make money in that trade and you get out, in the next trade you will lose the entire capital. So how many times time you can get hit and you can come back? Let me just derive an analogy from this film Rocky, Sylvester Stallone. In that, the rival says that I have hit him so many times. He goes back and then again he comes back at me. So this is someone whom I should not, whom I should stay away from. So it is the same thing in the market. The hits you can take, the punches you can take in the market. What is the strength of these punches? Believe me, on an account of 4 lakh rupees, you take 20,000, still you will be at a relief. I can come back. But once your entire 4 lakh rupees is gone, your account becomes ruined. Then the next thing you will think is from where the next fund will come and put it in the next trade and then again get ruined. So it is a cycle which needs to be broken, and only money management can do that for you. It is the single biggest factor that determines you are a success or you are a failure. Accept that you have gone into wrong in the markets. Accept that you are not God in the markets. Accept that yes, I have gone wrong. My analysis has proved to be wrong. I am getting out of the market, and then look for a next trade. Again, money is limited. Market opportunities are infinite. Opportunities are going to come, but to play those opportunities, will you have money or not? That money management is going to decide, because you have lost entire money on some other trades. Now, even if you are seeing an opportunity and you don't have money, believe me, it is the worst part you can go through. Arey, samne dikh raha tha mujhe, market is going to go up, but I couldn't trade because I did not have money. I lost everything. That is the worst thing which is going to happen to you. Opportunities will always be there in the market. Till this entire world is there, markets are going to be there. Till greed is there in human beings, there is going to be markets in this particular world. Opportunities will come. The time is, do you have the money to capitalize on it or no? It helps you identify the loss-making trade, because everything is there in front of you, like a result, you see answer paper. It is there in front of you. So it is the most important thing. You are going right if your account is in positive, or you are going wrong. And last but not the least, I have derived analogy from military, because if you are a good money manager, you have to think like a general, and the capital or the money as your troops. In order to win that war, where are you going to deploy those particular troops to win that particular war or battle? A good money manager is a good trader and not vice versa. This is something which I believe. If you want to become a good trader, I mean, know the basics of entry, know the basics of exit, but know everything about money management, you will become a good trader. I have explained this to you, that how will you take a money management stop loss. Let me reaffirm this, because till you understand money management, you will not be able to become a good trader. Here, on a total trading capital of 3 lakh, you say that you will not take more than 10% of your capital, or risk of 10% on your single trade. So 10% of 3 lakh is 30,000. You say whatever happens, agar mere ko 30,000 ka nuksan ho raha hoga, so even if the Almighty God comes and says no, this is going to go up, you say wait, let me exit, I will re-enter it. Money management stop loss, this 30,000 is going to be your money management stop loss. All your technical stop loss is going to be less than or equal to 30,000. If in case, I repeat, if in case your technical trading stop loss is showing that it is more than 30,000 rupees, don't take this trade. Opportunities will come. But if you are getting a trend line breakout, and if the value below that particular trend line is, if you calculate, it is coming total as more than 30,000, then don't take that trade. It's okay. You will see another breakout, you will get another opportunity. Now this is how I have calculated. How will it work out? Assuming that you put a risk to reward ratio as 1:2, okay, and you will get that. If the breakout is correct, you will get that 1:2 ka risk to reward, and you have a hit ratio of only 50%. Assume you have a hit ratio of 50%. okay, which is very normal. So if you are taking 10 trades in 5 trades, and in 5 days if your stop loss is triggered, your total loss is 1.5 lakhs. And if in 5 trades you are having profits, you will be having 1:2, so 60,000 ka profit. So it will be 3 lakh. Even in case if your hit ratio is 50%, you will still make money, take money out of the markets. Again, I have focused on leverage. I would like to say go for 1:3 because that is something that will help you protect your capital. Yeah, let me tell you this. Uh, if you see in the subprime crisis, most of the investment banks who claim that they have quant-based hedge funds and this and that, they had a leverage of 1:20, and this was perhaps the biggest reason why they collapsed. Because unwinding such a big leverage, even a slight drop in the market will see your profits eroding by 100%. So this is what happens when you don't concentrate much on leverage.